A single AI campus in West Texas now has permission to emit more than 33 million tons of carbon dioxide equivalent a year. But the sequel to this story is not just pollution. It is power. Amazon has confirmed it acquired the GW Ranch site in Pecos County and plans to buy electricity from an on-site energy platform built for AI. The permit says 35 gas turbines. Pacifico says 7.65 gigawatts of gas capacity, plus batteries and solar. Amazon says the point is to avoid raising electricity costs for Texas families while grid interconnection catches up. Critics hear something very different. Big tech is moving from the electric grid into the natural gas grid. Today we are going deeper than the headline. We will separate permit limits from likely operations, explain why the numbers look inconsistent, compare Amazon with Microsoft, Google, Meta, and xAI, and ask the real sequel question. If AI companies bring their own power, who carries the fuel risk? The new development is the paper trail becoming a company story. In January, Pacifico Energy announced that GW Ranch had received a Texas Commission on Environmental Quality Air permit for 7.65 gigawatts of gas-fired generation. At that point, it was a huge power for data centers platform with no named hyperscaler attached. The story changed in August, when CleanView and Distilled traced Amazon construction filings and satellite imagery to the same site. Amazon then confirmed it had acquired GW Ranch and planned to buy power from the plant being developed by Pacifico. That matters because it turns a speculative energy project into a direct AI infrastructure bet by one of the three cloud giants. It also gives us a timeline: January permit, July satellite evidence of land clearing, August construction filings and company confirmation, and first power targeted for the first half of 2027. The phrase off-grid can be misleading, so here is the precise version. The TCQ preliminary determination says the plant will provide electricity for an on-site AI data center and will not be capable of selling or receiving power from the local utility power distribution system. Amazon's own statement, reported by CleanView and Data Center Dynamics, frames the project as new on-site generation that will not raise electricity costs for Texas families and is designed to transition to grid-connected service as interconnection timelines allow. So this is not a romantic cabin off the grid. It is a private grid industrial campus built because the public grid cannot deliver enough capacity quickly enough. The grid bottleneck is the plot device. The gas plant is the workaround. The sequel angle is that the story has already moved beyond Amazon. TechCrunch reported on August 14th that hyperscalers are now betting on natural gas for AI data centers. But a new energy forecast warns that gas prices could triple in some U.S. hubs as demand collides with slower supply growth and LNG exports. That is the piece many outrage videos miss. Behind-the-meter power may shield the data center from the electric grid queue, but it does not free it from commodity risk. Fuel can be half the cost of electricity from a large gas plant. If gas prices double or triple, the economics of bring-your-own-power AI changes. The next battle is not only permits. It is who can lock fuel, turbines, land, water, and interconnection before the others do. The most important source is the permit file, not the viral headline. The TCQ preliminary determination identifies Pacifico GW LLC, permit numbers 181033, PSDEX 1672, and GHGPSDTX 255. It places the GW Ranch Energy Center on Highway 18, about 17 miles north of Fort Stockton in Pecos County. The project description says natural gas-fired simple-cycle power plant at a greenfield site, with nominal output of 5,000 megawatts. It lists 35 simple-cycle turbines, wet surface air coolers, dew point heaters, supplemental engines, emergency engines, storage tanks, fugitive emissions, and startup and shutdown activities. That is the machine underneath the AI story. The data center is not just racks and GPUs. It is a permitted industrial power complex. Now the number that made the story explode. The same permit table lists allowable annual emissions of 33,162,721.19 tons of CO2 and 33,204,964.44 tons of CO2 equivalent. It also lists 2,830 tons of NOx, nearly 5,955 tons of carbon monoxide, and almost 1,000 tons each of PM, PM10, and PM2.5. Two caveats matter. First, permit limits are not a forecast of actual annual emissions. Companies often emit less than the permitted ceiling. Second, the ceiling still matters because it defines what the plant is authorized to do without coming back for a new approval. The story is not that 33 million tons will definitely happen. The story is that an AI power campus has regulatory room on that scale. There is also a number puzzle. Why do we see both 7.65 gigawatts and 5 gigawatts? Pacifico's press release describes total gross capacity as 7.65 gigawatts of gas, plus 1.8 gigawatts of battery energy storage and 750 megawatts AC of solar. The TCEQ document describes nominal output as 5,000 megawatts. Pacifico says Phase 1 is 1 gigawatt, with first power in the first half of 2027 and a guaranteed pathway to scale to more than 5 gigawatts. The clean way to explain it is this: 7.65 gigawatts is the permitted gas generation platform, 5 gigawatts is the nominal plant output described in the AIR review, and 1 gigawatt is the first commercial phase. Confusing? Yes. Fabricated? No. The documents are describing different slices of the same build-out. Why gas? The simple answer is speed and firmness. AI clusters do not want power only when the sun is shining or when the grid has spare capacity. Training runs, inference demand, cooling, networking, and redundancy all reward firm, dispatchable power. Pacifico says GW Ranch is designed for more than 99.99% availability and has multiple gas supply laterals, including a 15-mile, 1 billion cubic feet per day direct pipeline to Waha. That location matters. Waha is a Permian Basin gas hub, and Data Center Dynamics cites EIA data showing the Permian accounted for 22% of U.S. marketed natural gas production in 2024. In other words, the data center is being placed close to fuel, not just close to users. But the workaround creates a new dependency. TechCrunch's August 14th piece cites NOREVA's warning that natural gas prices could move above $10 per million BTUs in certain hubs, while prices today range around $2 to $4.50, with Henry Hub just under $3. I checked market data with Affinance. The natural gas futures ticker NG equals F closed at 2.728 on August 14th, after closing at 2.662 on August 7th. That is not a forecast and not investment advice. It is a snapshot showing the baseline from which the risk is being discussed. If a company signs up for gigawatts of gas-fired AI power, it is not just buying electricity. It is taking a long-duration view on fuel availability, contract terms, and price shocks. This is why bring your own power is not as simple as it sounds. If the data center connects to the public grid, the fight is over interconnection queues, transmission upgrades, reliability, and who pays. If it builds behind the meter, the fight moves to turbine supply, gas pipelines, air permits, water, local opposition, and commodity exposure. TechCrunch previously noted that turbine costs and delivery times have become constraints across the industry. So the real moat may not be the data center shell. It may be the right to run a large plant, the turbines already secured, the pipeline access already negotiated, and the first power date already on the calendar. That is why this project is bigger than one Amazon campus. On the equity side, the reaction is not a clean one-day referendum on GW Ranch. Amazon is a giant company, and the stock moves for many reasons. Still, the backdrop matters. Using Affinance, Amazon closed at $274.48 on August 7th, the day CleanView published its Amazon confirmation, and at $262.96 on August 14th. That is a decline of about 4.2% over the window. We should not over-attribute that move to one data center story. But investors are now watching AI capital expenditure, cloud capacity, emissions, and energy sourcing as one connected bundle. A power plant story can become a margin story if it changes the cost of compute. Amazon's own sustainability numbers show why this matters. Its 2025 sustainability report says absolute carbon emissions increased 16% compared with 2024. AWS also says it added more data center capacity globally in 2025 than any other company, including more than 1.2 gigawatts in the fourth quarter alone, and expects AI and cloud services to keep growing. At the same time, AWS reports an average global PUE of 1.14 in 2025 and a water usage effectiveness of 0.12 liters withdrawn per kilowatt-hour of IT load, a 20% improvement from 2024. So there are two truths at once. The infrastructure is getting more efficient per unit, and the total build-out is growing so fast that absolute emissions still rise. The community reaction has been intense enough to become part of the story. On Hacker News, the New York Times version of the Amazon data center story reached 246 points and 324 comments. The arguments split into recognizable camps. Some users saw hypocrisy against Amazon's climate pledge. Others argued that the core issue is absolute scale, because a gas plant can be ordinary per megawatt and still enormous in total emissions. Another thread asked why wind and solar, often described as cheap, are not enough here. That question is the right one. The answer is not only cost per megawatt hour. It is dispatchability, interconnection timing, storage duration, land, permitting, and who absorbs reliability risk. Amazon is not alone. It is late to an increasingly explicit pattern. TechCrunch's April reporting described Meta, Microsoft, and Google all moving toward large gas plants for AI data centers. Meta's Hyperion project in Louisiana was described around 7.5 gigawatts of natural gas capacity. Microsoft and Chevron announced a West Texas data center power project that could scale to gigawatts. Google and Crusoe have been linked to a 933-megawatt gas plant in North Texas. In August, the Amazon number enters the same map at 7.65 gigawatts. The headline competition is AI models. The hidden competition is power procurement at industrial scale. xAI and SpaceX show the regulatory edge case. TechCrunch reported that SpaceX said it would remove unpermitted turbines powering xAI data centers near Memphis as it transitions to a permanent 1.2 gigawatt natural gas plant. But that full removal would not be complete until July 2027. The contrast with GW Ranch is important. Amazon's project is controversial because the permitted scale is enormous. xAI's controversy has centered on operating turbines before the permitting question was settled. Both stories point to the same pressure. AI companies want capacity faster than normal utility planning can deliver. When the bottleneck is time, companies test the edge of permitting, ownership, and local tolerance. There is also a clean power countermap. Amazon points to its carbon-free energy portfolio, and AWS says it is working toward net zero carbon by 2040 and water positive by 2030. Pacifico says GW Ranch includes 750 megawatts AC of solar and 1.8 gigawatts of battery storage. But the order of operations matters. Solar and batteries can reduce fuel burn, help shape load, and improve resilience. They do not erase a multi-gigawatt gas permit. Nuclear deals, long-duration storage, geothermal, transmission upgrades, and carbon removal are all part of the rival pathway, but most of them arrive slower than the AI demand curve. That mismatch is why gas keeps winning near-term decisions. For users, this looks far away until it reaches pricing. If a model company or cloud provider can secure cheap, reliable power, it can run larger clusters, sell more inference, and perhaps lower token prices. If power becomes expensive, scarce, or politically constrained, AI margins come under pressure. The physical cost stack of AI is no longer just GPUs and chips. It is land, substations, cooling, water rights, air permits, pipelines, turbine delivery slots, and long-term fuel contracts. That is why energy stories now belong in AI coverage. The performance race depends on silicon, but silicon only works when the power stack exists under it. For regulators and local communities, the issue is cost shifting. Amazon's defense is that new on-site generation will not raise electricity costs for Texas families. That argument addresses one concern, but not all of them. A private plant may avoid direct ratepayer upgrades on the electric grid, yet it can still draw on regional gas supply, local water resources, air quality capacity, road infrastructure, emergency services, and political permission. SEC's document says the project will not sell to or receive from the local utility distribution system under its permitted design. That narrows one channel of public exposure. It does not make the project socially weightless. For the AI industry, GW Ranch is a warning about narrative debt. Big tech spent years telling the public that cloud growth could be matched with renewable energy, efficiency, and long-term climate pledges. Amazon still says it remains committed to net zero carbon by 2040. AWS still reports efficiency gains. But when AI demand accelerates faster than clean firm power, the industry starts making choices that look very different from the marketing layer. The public will not judge only model benchmarks. It will judge electricity bills, air permits, water withdrawals, local construction, and whether climate commitments survive the next wave of compute. The first thing to watch is construction reality. Pacifico says Phase 1 gross capacity is 1 gigawatt, and first power is targeted for the first half of 2027. CleanView said satellite imagery captured land clearing on July 24, 2026. Construction filings reportedly show 3 Amazon data center buildings starting immediately. If equipment delivery, pipeline work, or local permitting slows, the whole AI capacity timeline moves. If the first phase lands on schedule, GW Ranch becomes a template. The market will ask which hyperscaler has the next private grid site, and which developer has turbines already secured. The second thing to watch is disclosure. Will Amazon count electricity from GW Ranch as part of its own operational footprint, as purchased power, or through a different reporting boundary? Will it disclose actual emissions once the plant runs, not just permit ceilings? Will it match the electricity with carbon-free energy elsewhere, by carbon removal, or claim that the plant is transitional until grid interconnection arrives? These details sound technical, but they shape whether climate pledges remain comparable across companies. If every hyperscaler reports behind-the-meter power differently, the public will not be able to tell who is actually decarbonizing and who is just moving emissions around the accounting map. The third thing to watch is policy. FERC has already pushed grid operators to move faster on data center interconnection and to consider behind-the-meter power. Texas officials have talked about making data centers pay for needed infrastructure and limiting large load approvals to protect residents and water resources. Those two pressures can collide. If regulators make grid connection faster and fairer, companies may have less reason to build private fossil plants. If grid queues stay slow, more projects will copy GW Ranch. The next AI bottleneck will not be a leaderboard score. It will be an energy permitting docket, a gas contract, and a local meeting where residents decide whether the age of AI should be built next door. So the update is this. Amazon's Texas project is not just a bigger data center story. It is a sign that the AI race is becoming an energy ownership race. The permit ceiling is huge. The first phase is timed for 2027. The climate accounting is unresolved, and the fuel risk may become as important as GPU supply. That is the piece to watch next. Subscribe to AI Daily for the next deep dive. And as always, this was a factual infrastructure breakdown, not investment advice.